Evidently, the middle class is rapidly diminishing at a concerning rate. The situation has become so dire that less than a year ago, Fortune published an article warning that the middle class was bracing for its next financial setback. According to Yahoo, the former backbone of America is reaching the end of an era, with middle-class wealth having reached its peak in February 2022.
Class was once a symbol of the American dream. But the American middle class today paints quite a different picture.
To delve into the reasons behind this alarming decline, explore whether it is a cause for concern, and understand how it will impact everyone watching. Let's discuss why the middle class is shrinking so rapidly. Additionally, we'll explore what you can do to avoid being left behind in today's episode of Stop Spending Your Money on Starbucks. Before we begin, if you find these videos valuable, please consider hitting the like button gently to show your support, and I'll do my best to respond to as many comments as possible. Thank you, everyone. To begin, in order to grasp the current situation and understand the significance of it, we need to delve into who exactly constitutes the middle class. In a manner akin to the extinction of dinosaurs, some suggest that the middle class is on the brink of becoming extinct. The concept of the middle class as everyday working Americans really gained prominence after World War II, as productivity and GDP surged. This allowed approximately 70% of American families to comfortably sustain themselves on a single income, with 50% owning their own homes, 50% owning cars, and being able to afford their children's education while saving for retirement.
Low-wage countries that really put the kibosh on blue-collar job opportunities in many places. The point is that it's not that the economy got worse, it was that there were policy decisions made so that
often with the aid of employer pensions. However, a pivotal change occurred in the 1970s when middle-class incomes began to dwindle. The precise cause remains unconfirmed, but it is believed that during the 1960s, the United States began losing its dominance in production quality and productivity to Europe and Japan. In response, the US adopted a policy of printing money and loosening economic policies to stimulate short-term growth. This strategy initially yielded results, but over time, it led to complications, ultimately resulting in the decision to abandon the gold standard in 1971. This single decision is believed to have disrupted the American wealth-building mechanism. Subsequently, the expectation that each generation of Americans would enjoy a better life than the previous one was no longer guaranteed. Following this, the 1970s experienced a fuel crisis that increased the cost of living. American muscle cars were increasingly replaced by more efficient European and Japanese cars. This shift marked the emergence of dual-income households, which temporarily prolonged the American dream for another generation. In the 1980s, President Reagan's tax policies encouraged free trade and enacted laws that favored large corporations. This led to a situation where the middle class could expand upwards to earn more money, but at the expense of pursuing higher education and embracing automation. Over time, this trend continued to intensify, resulting in more people either moving up to a higher income bracket or falling down to a lower one. Consequently, the middle class began to diminish. To compound the issue, wages for college graduates have been decreasing since 2000. And employers have been cutting healthcare benefits for young workers since 1985. The minimum wage, if it had kept pace with productivity, would now be $18, and CEO compensation is nearly 400 times that of the average worker. To comprehend the scale of this issue and why the middle class will likely deteriorate further in the coming decades, consider taxes. One of the most significant distinctions between the middle and upper classes can be observed in the differentiation between W-2 and self-employment income. If you work a conventional job with a fixed schedule and a set salary, you receive income as a W-2 employee. This means your income and tax withholdings are reported directly to the government, and you file a form at the end of the year to ensure you've paid the correct amount. Under this structure, you receive your pay taxes, and then spend what's left. On the other hand, if you are self-employed or run your own business, you operate with self-employment income. This allows you various deductions to reduce your tax liability. For example, expenses like a home office, transportation to meetings, or business lunches can be tax write-offs if they are legitimate. In this scenario, you receive income, spend it, and then pay taxes on what's left, potentially offering significant advantages to business owners. Additionally, consider depreciation as a tax strategy. For instance, some business owners can buy assets like commercial properties or business equipment, write off the entire cost of these items against their taxes, and essentially reduce their tax liability to zero. This tax strategy can enable individuals to declare significant income on paper while paying minimal to no taxes. The reality is that affluent individuals possess the disposable income to invest. When interest rates are low or inflation is high, these assets tend to appreciate the most in value. This explains why the top 1% amass twice as much wealth as the rest of the world. For example, low interest rates can boost economic activity, but this often occurs at the expense of stagnant wages and increased living costs. Those who profit from these conditions are typically individuals with strong creditworthiness, collateral, and a lack of default risk, making banks more willing to extend them cheap loans. As a result, the wealthy gain access to affordable capital at pre-inflated prices, which, as they continue to leverage and invest, pushes prices even higher. By the time others enter the investment game, profit margins are substantially reduced, or they buy at peak prices. However, it's essential to note that not everyone agrees with this perspective. Some data suggest that the middle class isn't declining as much as presumed. According to the Brookings Institute, when considering government assistance, health insurance value, and changes in household size, the bottom 1/5 of income earners had 25% more income in 2007 than in 1979. The middle fifth experienced a 37% income increase during the same period. Moreover, some studies show that the middle class is shrinking because individuals are moving into higher income groups. These findings suggest that the issue might not be solely an income gap, but rather an investment gap. In this context, it's crucial to acknowledge that having a strong credit score is paramount. A higher credit score increases your likelihood of securing loans with lower interest rates, leaving more money in your pocket. Start working on improving your credit score if you haven't already by obtaining a no annual fee credit card and paying it off in full each month. Another crucial step is to save your money diligently. Regardless of your income, saving a substantial portion of it allows you to seize opportunities when they arise, whether in a bear market or other favorable conditions. The ability to save is instrumental in capitalizing on financial opportunities. Investment is key. Wealthy individuals excel at investing, particularly during uncertain times when others are hesitant. They adopt a long-term perspective, unfazed by short-term market fluctuations. They view market downturns as opportunities to buy assets on sale.